Now we come to the financial market, or a simplified depiction thereof, which we use to derive the demand of households for money, the supply of money from central banks, and the equilibrium in this money market. Now, first of all, we note that money, which is typically denoted by M, consists of currency in circulation, CU, which is the banknotes and coins with which people pay, plus deposits at banks, D, that can be used for immediate payment. So the definition of money is basically that it's liquid and enables immediate payment. However, it does not pay any interest. So there is an opportunity cost of holding money because alternative investments such as buying bonds would pay an interest rate at each point in time. Now, households demand money for transaction needs because you cannot pay with bonds immediately and you have certain transaction needs per day, so money comes in handy, but they dislike holding a lot of it because of the foregone interest payments. So one can write down the money demand of households as a function of the price level. Of course, if prices are higher, ceteris paribus, you need more money to pay. Then it's a positive function of income, which is again immediately clear, because if you have more income, you tend to buy more goods and therefore have more demand for liquidity. And a certain liquidity preference function that determines how much individuals like to have liquid assets at their disposal. And this liquidity preference depends negatively on the interest rate to capture this opportunity cost effect that I mentioned before. So if the interest rate goes up, this L function goes down and people demand less money. For simplicity now, we abstract from the details of money creation by commercial banks and so on, because commercial banks only need to hold a certain amount of reserves for the deposits that they get from households and so on, so they can lend out some of the money that households bring to them for deposit. But we abstract from them for the moment and just assume that money supply, MS, is directly determined by the central bank. Now we illustrate the money market and the equilibrium on the money market in a diagram where we have the interest rate on the vertical axis and real money holdings, that's nominal money holdings, M, divided by the price level, on the horizontal axis. And first we depict the traditional view, which posits that central banks set the money supply M bar, while the interest rate adjusts if households change their liquidity preference. So what we then have is that money supply of central banks is a straight vertical line at the level of money supply by the banks and the given price level, which we assume in the short run to stay constant. So we are in the very short run actually, where prices do not adjust. So now we can draw the money demand curve of households, which is a downward sloping curve in the space of the interest rate and money holdings, M over P, because if the interest rate is high, money demand of households is comparatively low because of this opportunity cost argument, and if the interest rate is comparatively low, money demand would be comparatively high. The equilibrium now in this simple money market would be at an interest rate I1 that corresponds to the intersection of the money demand curve with the money supply of the central banks that they set at this given level, M bar. Now suppose that incomes of households rise from Y1 to Y2. This would then lead to a shift of the money demand curve outwards, and for every given interest rate, money demand of households would now be higher because they have higher incomes and more transaction needs basically. However, the central bank does not adjust the money supply, and what we would have is then a new equilibrium at a higher interest rate, I2, which is required to clear the money market at the constant money supply of the central bank. So in this traditional view, it's important that the adjustment goes fully through the channel of the interest rate. So if incomes change, the interest rate would rise or fall, depending on which change of income we are looking at, but the money supply of households would not change. So the central bank sets M bar and I, the interest rate, adjusts accordingly. Well, this view of the money market was taught in macroeconomics classes up until the Great Recession, but then there was some reconsideration, because actually we know that's not how monetary policy actually works. So if we have a more modern view, then it is the case that the central bank sets the interest rate while money supply itself adjusts. So we draw again this curve, but now the monetary policy would actually seek to keep the interest rate constant at the level I bar, and money supply would adjust in equilibrium. So we can again draw the downward sloping money demand curve for households at the original income level Y1, and we would have an equilibrium where the desired interest rate of the central bank intersects with the money demand curve, and that would be at the money supply M1. So the central bank would actually adjust its money supply such that this interest rate I bar that it desires is reached in equilibrium. Now suppose again that household incomes rise. So we would have that the money demand curve shifts outwards here for an income level Y2 that is greater than Y1. And we see that the original equilibrium would not be an equilibrium anymore. But what happens now is that the central bank increases money supply so as to maintain the desired interest rate I bar. So actually now the interest rate is fixed, and the whole adjustment runs through money supply of the bank, central bank. So we can now summarize. Money demand depends on liquidity preferences and the interest rate, because households want to hold money for being able to make transactions. But if the interest rate is high, the opportunity cost of holding money is high, because it doesn't pay interest, or only a very low interest in case of some deposits. Money supply depends on the policies of the central bank, and the equilibrium of the money market is where money supply and money demand intersect. Now, according to the traditional view, it's the case that central banks steer the supply of money and keep it constant, basically. And if something changes, a change in money demand, then leads basically to a change in the interest rate and no change in the amount of money in the economy. But basically, that's not how monetary policy is conducted nowadays. How it is conducted is that the central bank fixes the interest rate and adjusts money supply accordingly. So according to this modern view, central banks steer the interest rate, and a change in money demand would lead to a change in money supply, but the interest rate would stay fixed. As we will see in the next chapter, the different views here have important effects because they lead to different shapes of the LM curve. And basically in this more modern view, I would actually not even call it LM curve. It's a curve that represents monetary policy, but not the LM curve as such.